Yep. So good afternoon, everybody. First of all, thanks for joining us today. For those of you who don't know me, my name is Martyn Brooke, and I am the Client Engagement Manager here at Baker Ing. And I'm also this month's guest host for the Hosted by Henry webinar series. We've had a huge response to this webinar series, and for the benefit of those who have not attended before or previously, we seek to break down what the economists are telling us about in terms of what it means for credit management globally. And today we're taking a close look at Western Europe. As a reminder, you can actually download full Western European report from bakering.global/resources, where you can also access a full library of white papers, economic reports and fact sheets. In the days after the event, we will be making an executive summary paper of today's webinar available too, with more exclusive content from our panel and host of other industry stalwarts. So coming up now, we're going to jump to Tim Wendholt, Risk Data Specialist at Corporate CPR, who will be enlightening us regarding the availability of relevant data for this region. Tim will swiftly be followed by Bhav Chandengra, Strategic Sales Director of Aon, with some insights into the credit insurance market. We then follow him with Cees Jansen, Chairman of the Dutch Institute of Credit Management, who will then be speaking from the Netherlands perspective on the status of creditors, followed by Adrian Hyde, partner of Begbies Trainers, who will tell us all about the current state of insolvencies in the region. Last, but by no means least, we have Declan Flood, Chief Executive of the Irish Institute of Credit Management. We'll finish up with his presentation on post-pandemic credit management in Western Europe. We purposely made each presentation very brief, as we can round off this afternoon with a Q&A. So please, I ask you to submit your questions to me via the chat function as we progress today. I hope you get a lot out of it, and I'm now going to hand over to, I believe, Tim is our first speaker today. Tim, I'm going to press the button for you. So over to you, Tim, to introduce, I guess you'll introduce yourself, but I've already done it. But over to you.
Thank you, Martyn. Thank you, Martyn. Yeah, Tim Wendholt, around about 35 years in the business information industry, and prior to that as a credit insurance underwriter. So I've been a user of and a seller of information, data, call it what you will, for quite a long time now. By dint of the fact we have 10 minutes, I've kept this pretty brief, as you would imagine. And I've got a very bland title of data availability. I was tempted in my darker moments to think, oh my God, what are the rubbish credit agents are selling us as a title, which was a little bit unfair, but it's what I think almost on a daily basis. But we need to look at the challenges they face, as well as the data that they're providing to us. So a few headlines to start with. So Martyn, if you could click onto the first slide, that would be handy. And very simple stats here, not bang up to date as of the end of June, but end of Q1 2021. And I've chosen just to show countries where there are 1 million known to be trading businesses of all sizes, of course. And you can take it that anything else, any other country rather, is sub 1 million records. Clearly, you then have to look at this in relative terms. What is the company? What are the country GDP? So my conclusion from this little basic stat is that Germany, whilst having fewer businesses, and long known, does actually therefore must have a lot more large businesses rather than small non-corporates maybe, but generally small businesses anyway. And when you apply to that statistic, the COVID facts, if you want to call them that, that since June maybe a little earlier in some countries of last year, there's been almost an explosion of new startups. In the UK, for example, we've seen a phenomenal increase June right the way through to the end of the year. Similar statistics are being seen elsewhere. These are all companies that are formed at Companies House, not those who are yet as to be yet recorded for VAT returns and things like that. But the interesting thing is that as of June this year, the UK statistics showed there was a drop of around about 50% of startups compared to a year ago, which suggests that there's a relevance of new startups to government funding and support through the economic downturn and the lockdown. Now, whether that will also apply on other parts of continental Europe remains to be seen. I just don't have those statistics available, but it's interesting to see that huge drop-off in the last month or so. Now, if you go on to the next slide, Martyn. Yep. Bear in mind the number of startups that I've been talking about. It would be fair to say that across Europe, data is generally and readily available. If you go look for it, you will find it. But also bear in mind that across Europe there are different means and time limits for filing, particularly financial data, and where it is available, it's often patchily enforced by regulatory authorities. Now, again, remember what I just said about startups in the last year to 18 months. It's very unlikely that they will even be required to consider filing any data, probably until the end of this year at the very earliest, more likely into 2022. So as credit managers, we're being asked to look at potentially businesses with no track records, not likely to be any track record in the near future. And then, of course, with that comes the possibility that many of those businesses were started on the back of government funding. Who knows what's going to happen to them once that government funding disappears. I've used the expression is going or gone. In many cases, and in certain sectors, that's already gone. So instead of looking to government support through the treasuries of the various countries, people will now be looking for trade credit if they wish to continue in business. Now, the other time limit here, of course, is that those businesses which were trading prior to the economic lockdown will have business models tuned into a pre-pandemic economy and the behavior of people who drive that economy. Who knows quite what's going to come out at the other end of it eventually, but as we can see in the UK, high streets are generally dying. Logistics companies are booming. But of course, without fresher data, it's almost impossible to see to whom that applies. It's a constant struggle trying to obtain more up-to-date financials in all countries. Many still have only filed 2019 numbers. Of course, I have seen some where 2021 numbers have already been filed, but they tend to be people who are cash rich, strangely, with long-term debt on their balance sheets as well. But with no clear transparency around how they're going to repay that debt or when. Next slide, please, Martyn.
Yep.
Now, one of the challenges that businesses face when they're looking at data in general, yes, it's great to have the financials, but there's a lot more going around. And whilst it's available, as I said earlier, in most European markets, the data is generally not joined up. It's a bit of a sweeping statement, but in an age where we're looking at critical issues such as ultimate business ownership, I think it's fair to say that that particular challenge has not yet been dealt with across the European databases. Of course, several have launched predictive scores to help deal with COVID, but they're all based on old financial data with guesswork as to what the new world might be. I'm sure there will be statistical guys who will argue the opposite, but in practical terms, my experience at least is the opposite. Now, of course, the challenge faced with new companies is worse, as we've talked about already. But if you're a credit manager seeking international data on a new business, you seriously have to wonder about why they're approaching you from another country for trade credit rather than going to a local funding source. But good practice then just kicks in, and those of us who've been in the market for a long time basically have to go back to basics, as I say. And as I mentioned in there, if you check your own company's industry classification, I bet it doesn't say bank on the door. So it's always good to make sure that basics are followed. Make sure that local registration numbers and VAT numbers are provided, because credit agency databases are unfortunately strewn with duplicate records. Despite their supposed best efforts to avoid that, unfortunately, it is the case that there are many duplicates across the whole of the databases, made even worse when businesses within the sector are sharing databases and trying to bash them together to make them look as though there's one single database across the entirety of Europe. I wanted to show you a slide in here around how tricky the viewing of ultimate business ownership can be. And I'm not sure, Martyn, whether this is on the next slide or whether it hasn't materialized on these slides. Could you try the next slide for me, please?
Of course, yes.
Thank you.
I'll get it to advance, which I will then. There you go.
Oh, there we go. Lovely. Perfect. These are just a couple of examples, all taken from the same database provider with, in this particular case, these are rental clients that I'm aware of for a particular provider of logistics services. And you can see the first four are all very common to one global brand. But when checking the financials and the parent structure, that same database, despite it providing data from one single place, has a mishmash at best of corporate parentage. Now, we all know that Amazon Group is owned ultimately by Amazon.com Inc. But unfortunately, as you can see here, that global ultimate name is too frequently incorrect. It's very simple to work out why. It's because there's a black hole of documentation in Luxembourg, but it doesn't alter the fact that the data is providing misleading parentage information. Ditto with the Xerox example I've also provided. Now, Martyn, if you go on to the final slide, that would be great.
Here we go.
I'm feeling as though I'm approaching the end of the Tour de France, pedaling furiously. The point I'm trying to make here is not that credit agencies and credit data shouldn't be used. It's an essential part of the business process. But I have a construction client for whom I provide procurement and supply chain risk analytics. And the commercial director says to me regularly, we don't use you, Tim, to provide an absolute yes or no. What we do is get you to harvest data so that we can have an intelligent conversation. And that's the way I would like to see folk using credit agencies, not to provide an absolute outcome, whether a yes or a no, unless clearly things are desperately bad, in which case that will be a fair approach to take. But because if you're if you're buying data from a single source across Europe, there's every chance that that data is coming from multiple sources, which brings inconsistencies into the whole data structures. And of course, if the data structures are inconsistent, so will be credit scores and credit recommendations. There are guides. I know if you read the T's and C's, that's what it will tell you anyway, but that's not how it's sold, of course. I'm just simply saying here, use the data, but use your own common sense much more than perhaps you would have done pre-pandemic because of the new startups, because of the inappropriate business models that are now in existence. I've often described credit agencies as more these days as being process enablers than risk information providers, because the data is so disconnected. But it will nevertheless play an essential part of process, because it's a darn sight cheaper to use that as a hub than it is to seek the data out yourself. It takes time. It's obviously more expensive than hopping on an aeroplane and going somewhere. But what I'm saying here is, with a very critical eye, use the data and don't be afraid to argue the toss with people who try and tell you that it's perfect when it's not. Stand by your own experiences in using this stuff. And looking at my little clock going here, because I can still tell the time, it looks like I might be over a minute beyond my time. I apologize for doing so. Please do ask questions via Martyn. I'm going to be hanging around with a cup of tea on the go, possibly a biscuit, and listening to the rest of the interesting conversation. And thank you so much for your time, folks. Have a jolly afternoon.
Okay, thank you, Tim. We have got a question coming already, but it won't be given to you now. Okay, you have to wait. Okay, thank you anyway. Right, moving on swiftly. Bev, over to yourself. I'll let you introduce yourself if you wish, but it explains quite clearly on the chart, I think, there. So let me know when you wish me to proceed.
I will do. Thanks very much, Martyn, and thanks for that, Tim. Some great insights there. Yeah, I mean, obviously, you can see who I am, but just by way of quick background, I work for Aon, who a professional services firm within the risk, retirement and health solutions side of the business, and I work particularly focusing on the credit solutions and working capital solutions for Aon, and I'm going to be providing some overview and some insights in terms of the credit insurance market to Europe, and some focus in terms of the hospitality and accommodation sector as well. Over to the next slide, Martyn. So I thought it was just important just to just review where we are, and obviously what's happened since the pandemic commenced last year. And throughout my experience, we've seen obviously lots of commentary around the global financial crisis back in 2008, which most of us will remember, unless you're very young and weren't working. But I remember it vividly because I was working for a global bank at the time. And it was obviously truly horrific in terms of what we were obviously seeing and going through. And in terms of the comparisons that have been made, I thought it was just important to sort of highlight that it has been very different. Okay, it has changed our lives, and we've seen obviously the disruption for the last 18 months. But the global financial crisis is very different in terms of what we're seeing with COVID-19. So that's an important factor in terms of what we're seeing through the credit insurance market as well. Over to the next one, Martyn. So in terms of the reaction that we'd seen, the insurance market, back in 2008, it was down to simply removing or reducing cover across the market, across the portfolios. And as I say, I was working for a global bank at the time, and we were getting notifications coming through daily in terms of specific sectors, specific graded customers, specific exposures needed to come off. And we were given 24 hours notice, sometimes maybe 48 hours if we were lucky. But it was very fast paced. It was obviously highly pressured, and you can all obviously appreciate the implications when that's being filtered through to our clients. So it was a very difficult time, obviously, which we'd obviously got through, but it was very, very challenging at the time. Over to the next one, Martyn. So let's fast forward to 2020, and obviously with the start of the pandemic and issues that we were seeing around the globe and eventually coming across to the UK, we were sort of expecting maybe a similar situation and scenario. So there's real concerns around it. But I have to admit, it's been very different this time round. So with, as you can see, some of the areas that I've listed, with the support that was provided from the government, the way the credit insurance market operated this time round was, the opposite side of the spectrum, in terms of there was a lot more dialogue and communication. The process was very well managed. And this was, clearly lessons were learnt from 2008, which was really, really pleasing to see, because lots of us were expecting maybe a similar position, but thankfully that didn't occur this time round. Over to the next one, Martyn. So in terms of how the market has continued following the outbreak of COVID-19, initially, as I said, there was a sense of concern, but if we consider how the credit insurance market has been for the last 10 years or so, the market has been really soft in terms of there's been strong economic growth. The insolvency rates have been low, capacity has been there. The pricing has been historically low as well. So there's been a lot more flexibility that we've seen from the credit insurance market. The key to all of this, and obviously what we've seen throughout the UK, was the support and the stimulus provided from the government, and this is throughout Europe. You can see the graphic that I've listed there on the right in terms of the EMEA region, but it just goes to show obviously how the claims position is currently. And obviously the government schemes that were introduced, the key for them was to stop the mass risk actions in terms of limits being withdrawn or reduced, and they did their job, in terms of holding that capacity, ensuring supply chain isn't disrupted like it was previously, and that obviously gave us the confidence in terms of what we do in terms of supporting our clients, knowing that cover has remained, has not been taken away as it had done before. The support measures obviously are protected the economies, they've protected obviously the clients, but I think we all accept that it is an artificial position really. We're not exactly sure and obviously what lies ahead, but we know that the measures that have been taken are obviously have stemmed the actions and the insolvencies and claims that the credit insurance market thought they would see. So in terms of the numbers, as you're all probably aware, they are obviously very low when we compare it to 2019, and looking ahead for 2021, we are obviously expecting an increase. I think some of the insurers are expecting a 20% increase going into next year compared to 2019. And obviously this will be impacted by the government measures and stimulus being phased out. In terms of the credit insurance market, that scheme has already expired on the 30th of June. And that's obviously occurred throughout Europe as well, where these trade credit insurance schemes were put in place to maintain cover levels of capacity. We feel that they've done their purpose, they've done their job in terms of holding that cover, but eventually those risks had to transfer back to the credit insurance market. And going ahead, depending on obviously how the pandemic unravels throughout Europe, we're going to see obviously changes there with how they operate and how they evaluate and assess the risk. But the good thing is that the insurance market has remained and continued supporting clients, and that has continued throughout not just Europe but throughout the globe. Next one, please, Martyn. So I thought it was important just to review obviously the position from the credit insurance market and what the underwriters see. The market is dominated by the big three trade credit insurers, which are Euler Hermes, Coface and Atradius, and they account for about 70% of the trade credit market. Our experience to date, although it has been very difficult for them, we accept, it's been challenging. There's been obviously concerns around pricing and risk and how to balance these. But at the moment, the way we're seeing things after the initial shock of the pandemic is that things have settled down, that pricing, etc., risk capacity has stabilized. So the positive here for the credit insurance market is that things haven't been too different really. There are capacity constraints, I have to admit, but the attitude, the approach, the dialogue, and the commercial view taken by the underwriters has been really positive. And that's obviously reflected in terms of the client portfolios that we're looking at, and also the new business opportunities that we've been working on. Throughout EMEA and throughout Europe, like the rest of the world, the economic uncertainty remains attached to obviously COVID-19. And also for Europe, there is the implications of Brexit as well. But as many businesses continue to rely on government support to survive, there are concerns around zombie companies and how that will obviously impact the global trade, and also concerns around the continuous spikes in infection rates, tightening of restrictions, the expected rise in unemployment, etc., once furlough schemes have ended. So if we're looking at it from an economic perspective, with the way the economy is at the moment, there are concerns, but I think there has been lots of positivity in terms of the measures that have been put in place. And I think we're hopeful in terms of it returning to sort of pre-pandemic levels going into sort of 2022 and 2023. Obviously, a key part of this will be the vaccine rollout, and that is obviously been progressing really positively and really well throughout Europe. And as businesses continue to operate within obviously the restrictions, hopefully we're going to see more easing of lockdown, and that will obviously allow underwriters to be able to feel more comfortable with assessment of risk. The final point I'll just sort of highlight from the underwriter view is that whilst the pandemic had taken over in terms of their analysis of underwriting, Brexit was still there in the background, and that is still of concern in terms of how trade has been impacted, and obviously in particular what the UK is seeing with the reduction in trade with the UK, with Europe, sorry. But it's a blend of all the information available and all the economic factors which are playing into their underwriting view. Over to the next one, please, Martyn. I thought just on this slide that I'll just provide you some oversight and insights into some of the information that we see here at Aon. So we rely on obviously the data analytics, and from the credit limit approval rates that we're seeing, as you can see on the chart on the right hand side, it's really pleasing to see that we're back to sort of pre-pandemic levels. You can see the different regions around the globe, and EMEA, in terms of including Europe, you can see we're really back up to sort of 70-75%. So that's been really positive. You can see the impact that it had in June, where obviously down to the pandemic, the capacity reduced significantly. But as time has gone on, as I've said, the underwriting market seemed to have been more comfortable, and that has obviously led to the acceptance rates increasing in the right direction. Now, I have to sort of emphasize in terms of the portfolios and the risk actions taken, it does vary from sector to sector. And as you can appreciate, in terms of the hospitality, leisure and accommodation sector, it has been impacted the most. I think at the moment, in terms of the trends that we're seeing, limit approval rates are about 52-odd%. So it's quite significantly down compared to other sectors. If we were looking at food and beverage, for example, or pharmaceuticals or technology, those sectors are running, well into their 80% acceptance rates. It's true to say with the whole hospitality and accommodation sector, the underwriters are, approaching with caution. It is a red sector in terms of how it's categorized, and the limit coverage and limit acceptance rates do vary throughout Europe as well. So if we're looking at Germany, for example, who's been one of the most advanced countries, in terms of the fight against COVID-19, we're seeing around 70% limit approval rates. If we compare it to the other side, so if we're looking at somewhere like France, for example, or the UK, it's running about 52%. And if we looked at Spain, who are probably, in terms of the major economies in Europe, it's only running at 39%. But, that all makes sense if we look at differing lockdown measures and obviously the impact of COVID and the restrictions in those countries at the time. Over to the next one, please, Martyn.
We're at time, Bav.
Yeah, it's just the last slide now.
Okay, fine.
Yeah, so just to finish off, and in terms of looking ahead, there's various aspects I'd say that have been taken positively over the last 18 months in terms of how the credit insurance market has operated. The uncertainty remains. The market itself seems to be stabilized in the state of calm, but understandably, there is obviously restrictions specific to this sector. There is opportunity for newcomers, so looking at obviously renewals and new business opportunities for those who are looking at or considering credit insurance. There is definitely appetite there in the marketplace. I suppose the key to all of this is in terms of how we recover and come out of COVID-19. There's going to be further, obviously, disruption. There are going to be gaps in information, and that is obviously reliant on what public information is filed, the late filing of accounts, etc., and the re-emergence of companies. But as I've said, the key to this is information, and providing you can provide the latest information or have access to the information, that will help the underwriting market to assess those risks and be able to support. So I think that's enough from me now. So I'd like to thank everyone for your time, and I look forward to any questions at the end of the session. Thanks, Martyn.
Okay, perfect. Bav, thank you very much. So we've got off to a flying start with Tim and Bav in our examination of the region. So we're going to continue swiftly along in the interest of time. Cees, I believe it's now yourself. Cees, I'll hand the floor over to you.
Martyn, thank you. My name is Cees Jansen, and I am the chairman of the Dutch Institute of Credit Management, or as we call it in Dutch, the Vereniging for Credit Managers. When I got this invite to talk about, what are the content, look at the opinions of the economists about what's going on in the Netherlands, and I looked at that excellent report that was sent to us, I decided I wasn't going to go into too much detail about what's happening in our economy, but I wanted to share some things that actually are on the top of our minds in the Netherlands in the area of credit management. So Martyn, if you could go to the next slide. That means that there are two things that I want to talk about. One is, what keeps us talking these days? And I'll briefly talk about it. And then I would like to share with you the results of a recent event that we have started in the Netherlands with some of the credit management associations about the position of the creditor. So if you go to the next slide, please, Martyn. I'm not going to surprise you that there are a lot of talk about going on about COVID-19. We had our Freedom Day, or the day of the end of our curbs, at the end of June. It was announced with a lot of hoo-ha and fanfare by the government, and everyone thought, okay, we're going back to a normal life. And what you can see in this little graph at the right-hand side of the slide is that we went from a very low number of infections immediately to something that was 7 or the latest numbers even 8-fold as much as what it was before. So what happened? Despite some warnings, I think the government kind of underestimated the consequences of going, totally back to normal. First of all, we had a lot of high school leavers. There is a tendency to go to Portugal to celebrate. They came back and they brought back a lot of infections. Remember that also in the Netherlands, the young people have not yet been vaccinated. Secondly, what happened was also that the health minister kind of introduced a slogan where he said dansen met Jansen, which is translated go dance with Jans, and that was the Janssen vaccination. And he actually said to everyone, if you go get your vaccination, then tonight you can go to the nightclubs and to the festivals. So that is what lots and lots of young people did. And, no surprise, we had some events where 30% of the visitors tested positive. So what it means is that we're all kind of being apprehensive. Are we going to go back to a situation with more curbs? The second thing that is really on the top of our minds is the housing market. Not specifically to the Netherlands, but since the beginning of the pandemic, the housing market has actually gone completely crazy. We have a 20% price increase compared to the second quarter of 2020, which is the largest increase since 1995. Supply is low, significantly lower than last year. And there is what they call a tightness indicator. How many houses do you have, can you choose from if you're on the market to buy one? And for the average terraced house, the tightness indicator is 1, which means that you have the choice of just one house and that's it. How come? What has happened here? And there's a couple of things that happened in the Netherlands that actually are contributing to this extremely explosion of prices. And that is, 1, there is no capital gains tax in the Netherlands. Secondly, if you're under 40 and you have rich friends or rich parents who want to give you 100,000 euros, then you don't have to pay any taxes on that. If you're under 35, you don't have to pay any stamp duty. And second, and finally, because of the extreme low interest rates, and that is what you see in the UK as well, we have buy-to-let investors that come in the market, overbid everything and buy those houses. So house prices are going through the roof. Bad news for starters, good news for house owners, because they feel rich. And that actually goes to the final thing that we have, and that is we have the lowest level of bankruptcies. Governments, analysts were all kind of completely surprised by what's happening, and that the government was supporting the industry for so long. So that is one. You have the government subsidies, the government support schemes, but also, like what I just said, the consumer feels comfortable, the consumer feels happy, and lots of industries are actually benefiting from that. If you now want to do some remodeling on your house, your waiting time is probably at least 10 to 12 months before you find a construction company willing to come and work with you. So that is on the economic side. There is also, and that is actually funny, something that happened not so long ago. A building company, a construction company went bankrupt, not because they did not have any customers, but because they couldn't get the materials. And obviously also materials are increasing in price. So what is valid for the bankruptcy in the B2B is also in the B2C area. B2C customers haven't been able to spend their money on going out on vacation, so they have actually been paying their debts. And if you talk to utility companies will tell you that their portfolio looks better than it has been done in many, many years. Yet, and that is the next slide, and that is the next topic that I wanted to discuss with you. There is a serious debate going on, and already since probably 2016, 2017, about socially responsible collections. A huge focus on protecting the buyer, protecting the debtor, and trying to avoid problem debt. Lots of legislation is also being introduced, but what is happening with all these initiatives and this legislation is that the position of the creditor is being eroded. The old pacta servanda sunt, debts have to be paid. That is actually going at the expense of the creditors. So the industry, 4 industry associations have come together and have started an initiative to bring to the attention of the public, but also the governments, that we should restore the balance between the vendor and the buyer and end the government's preferred creditor status. Martyn, if you go to the next slide. So the 4 organizations that I'm talking about that are the the organization, the KBVG, that is the organization of bailiffs. Bailiffs are in part of the court system, but they are independent operations. They have to run their business paid for by the fees of the collection, the money that they collect. The second organization is the NVI, the Association of Certified Debt Collection Agencies. Third organization is the VCMB, that is the Association of Credit Management Organizations. Part of credit management organizations are, again, bailiffs, debt collection agencies, credit status information agencies, credit insurance companies, IT companies, so everyone who is active, all companies that are active in credit management. And finally, the Institute of Credit Management, our organization representing the credit managers. To give you a bit of an impression of what is the size of the industry, credit management turnover is about 640 billion. Problem debt is estimated at between 6.4 and 12.8 billion euros. The NVI members, they say they manage 9 billion and every year, and that is 4 million cases. And they do that outside of litigation, 92% of the cases. So what did we do? Could you go to the next slide, please? We put together a series of webinars, and we invited representatives of those associations together with an audience, and we said, okay, let's have a few statements, let's discuss about that, and then come up with some ideas. And on the basis of the outcome of this first webinar, we then came up with a second webinar, and that led to some recommendation. And then finally, this is something that is really recently decided, we will come with another event towards the end of October, where we try to set up an event where we combine and where we bring together the part of the politicians and the credit management organization representatives. I have another 5 minutes left, so I will quickly go through some of those statements. I'm not going to read them to you because you can read them yourselves, but when we put that statement to the audience, 75% agreed. And they came up with some observations where they said, okay, credit managers should improve their communication. They should specifically explain how the credit management industry can contribute to helping. And that is one of the key themes that came out of it, where many credit management associations said, we have a lot of experience, but actually the market doesn't recognize that, the market doesn't use it. If you go to the next slide, we had another statement where we said the consumer debt aimed at avoiding poverty undervalue the position and the contribution of the creditors. Again, kind of, repeat of what I just said. And again, 78% of the attendees kind of agreed to that. And actually, we do want to get the message across that the vendor accepts their responsibilities and they provide active customer care if problems occur. You don't have always to legislate for that. The industry is working on it. If you go to the next slide. So what specifically are we talking about then when we talk about the fact that the credit industry, credit management companies, the credit management industry can contribute and can help, and actually what is the strength that they have? And we think that one of the strengths that we bring to the table is the extensive expertise in customer profiling and segmentation, and also the expertise that we can then use to develop more automatically tailor-made collection procedures. The picture that I have here is actually a picture that I have borrowed from a company called GGN, one of our bailiff companies, where they have actually identified, from left to right, really problem payers to kind of, well-to-do payers that actually are a little bit lazy in making the payments. If you go to the next slide. And then finally, we have an issue that is very specific to the Netherlands. I don't know what you've heard about it. We have the childcare benefit scandal, or the childcare allowance affair. Briefly, what happened was that in the Netherlands, you have to pay for your own childcare, but under certain circumstances, you can actually qualify for government subsidies. Now, something happened a few years ago. There were some fraud schemes identified with subsidy schemes, and the parliament actually told the tax authorities, you've got to kind of, enforce and make sure that, you avoid fraud. And then if anyone is defrauding the system, then go for it. Now that's the tax and revenue service has taken it a little bit literally, and they started to kind of quickly identify people who honestly made mistakes in their application for those benefits, and they qualified them as potential fraudsters. And if you are a potential fraudster in the Dutch tax system, you are in a very bad position. You are being chased for your debt in a very kind of rude, brusque way, and you're liable for high fines and penalties. And so that has gone on, and for a long time, actually, those companies, those 30,000 families were in difficult position. And then it turned out that the government was actually the revenue service was not kind of getting into a dialogue. And then all of a sudden, everything had to turn down. It was actually also the reason that the Dutch government fell and is now kind of a caretaking government. They fell, and they immediately turned around and said, okay, now all those impacted families, we will give 30,000 euros. And that is actually the gripe of the credit management industry. We now expect all the credit, all the vendors also to cancel all their outstanding debts that they have on those people. So again, the government was actually trying to kind of offload one of their problems onto the credit management industry. So all these things together then, and if you go to the last slide, Martyn, then led to a list of 11 statements that we want to start to discuss with the government that help guide the future developments. 11 statements, if you are good in history or religious history, it was not just a coincidence. Someone actually nailed 11 statements to a church door. So we have 11 statements as well. And here are the statements that we are going to discuss. The key statements are actually the key element of the statements. We're not going to go through them all, but it is use our expertise, work together, share information, and also municipalities, if you are working on debt relief programs, do that in a standardized way and share all the information. It's a unique initiative. I think I haven't heard of any other countries where something like this is happening. Yes, other countries, they all have the socially responsible collections, but the way of actually starting a dialogue with government and all the interested parties, I think is unique for the Netherlands. And I'm happy to be able to, in the future, to actually tell you and share with you how things develop. Thank you. That was what I wanted to share with you. Martyn, thanks for the invite to make this presentation, and I hand over back to you.
Perfect. Thank you, Cees, for that. A lot of information there, so thank you. Right, we're going to move swiftly along. As I said, for the interest of time, we want some time for Q&A at the end. Just to remind you, please start sending your questions in, and obviously we'll get to them at the end, so just a reminder. Right, Adrian, here we are. Adrian, are you there?
I'm indeed.
There we go. There we go. Perfect. Just let me know when you want the slides proceeded.
Absolutely. So I'm Adrian Hyde. I'm an insolvency practitioner and a solicitor, and I head up the Begbie's Trainer offshore practice. And I've basically done insolvency law and insolvency since the early 90s, which is a useful touch point in terms of where we are at the moment. The last sort of what I, as an insolvency practitioner, would call a proper recession was really the 1990s, as opposed to the financial crash in 2008, and you can start to see the highlights, the key indicators that opinions say will lead us into a recession coming out of this. And the key ones, actually, is it interesting to hear Cees talking about the cash. You know, in England, we've got a very clear situation of people having a lot of cash where they've not been commuting to work, they've not been buying their lunch and their coffee. We saw bank savings go up from 4 billion in March last year, net savings, to 16 billion in net savings in March this year. That's led to a huge increase in construction, in house extensions. That itself has led to, along with extensive house building here, and again, you hear the same issues in the Netherlands with their housing sector, as is causing issues with construction companies going bust because they can't get supplies, going bust because they're committing to contracts at particular prices, and the materials are going up every week or 2 weeks. So it's interesting to see that, and you can see how the COVID measures that have been brought in many countries have fueled that, because at the other end of the people that are saving lots of money, there are huge numbers of people who have been unable to work. And we can see, we'll look briefly at how different countries have dealt with that. But so the key things just to talk about, I think, where these webinars started, in a discussion we had at the last one of the key things for credit managers is information, and information on the ground, local jurisdiction information that's effective is what everybody needs, because that's going to help them get the best out of their recoveries. What we've got across Europe is we've got very localized changes to insolvency legislation. And you'll see when I go through the 5 countries in a moment, there's quite a split with how they're done. But the other point that you have overarching all of this across Europe is there has been a very significant change in insolvency culture in the last 5 years. And it's been very slow to kick off, but there's been a move very much towards restructuring tools. So the moratorium that we now have in the UK, we were one of the first in Western Europe to have that. But what you do see across Western Europe now is a significant number of countries that are bringing in new insolvency regimes. The Netherlands brought in a new restructuring regime in January. Italy has postponed theirs. It was due to come in late last year. It's now coming in September this year. So that change in the culture in insolvency is going to have an effect, and it's something that people are going to need to bear in mind. But another point, picking up on something that Tim mentioned, is Tim mentioned the time lapse in availability of accounts and numbers for companies. One of the issues you are going to see in the coming 2 years is some very big changes in what the numbers look like that you get, because quite a few of the COVID insolvency rules that have been brought in change metrics that allow people to carry on where otherwise they wouldn't need to be. So some of the regimes where if you're signing your accounts as a going concern, you have a look forward period of 12 months. You know, do we have enough cash to keep going for 12 months? Well, a number of of Western European countries reduced that look forward period from 12 months to 4 months. So when their accounts come out, accounts that are being signed off at the end of this year and filed and subsequently filed will have a different look to them, because they don't necessarily need the headroom in them that they would have done previously. Similarly, a number of countries have reduced capital adequacy requirements that would have meant that the board had to file for insolvency, but actually because they changed, rather than changing their insolvency rules, they changed their capital adequacy rules so that people didn't have to actually contemplate an insolvency process. So I suppose that this is just a heads up of the things to be looking at in the local jurisdictions, because people are going to need to keep a close eye on things going forward. So just looking at a few countries, a few examples, and I said there's a bit of a split across Europe as to how these things are dealt with. Looking first at France, the government have provided support packages with guarantees for lending, but they have a lot more of a collaborative insolvency process. And what they've done is they've extended all of their insolvency measures bar one to the 31st of December this year. So debtors are encouraged to renegotiate facilities or their indebtedness. The negotiation process is well established there, and they have the use of 105 credit ombudsmen to use in that negotiation process. Creditors aren't able to open insolvency proceedings in France now up until the 31st of December this year. Directors who believe their company is in difficulty, but it's as a result of COVID-19 issues, they don't have to commence any insolvency process either until the end of that period, unless they would have needed to in March last year when COVID started. And their legislation provides they won't be criticised for that delay unless there's been fraud. The only measure they actually stopped on the 31st December last year was a slightly controversial provision allowing the management to do a pre-pack of the going concern business to themselves. But thankfully that finished at the end of last year. Similarly, looking at Spain, it's a more creditor-friendly regime generally, but their institutional lenders stepped in and are not taking enforcement steps. From an insolvency perspective, the duty of directors to file insolvency has been postponed until the 1st of January next year. So from the 1st of January next year, the 2-month period that they have to start insolvency process kicks off. Likewise, the court's consideration of creditor filings for insolvency are postponed until the 31st December this year. I'm not quite sure what's happened, what will happen in Spain, because there was no bar on presenting a petition. The only effect was that the court wouldn't consider them. So there may be piles of petitions sitting in court, all in an alphabetical in time order, waiting to be heard, or there may be very few. Similarly, if in the meantime a debtor has filed a voluntary arrangement, their voluntary arrangement will take precedence in the period up to the 1st of January next year, and it will prevail over any creditor application. Any court-sanctioned refinancing, so voluntary arrangements or restructurings, can be amended up until the 30th of September this year, regardless of whether they've gone over the 1-year time limit for doing that. So those are the two sort of very, very debtor-friendly places. The others are very quick just to whiz through. I mean, Italy, there are fairly limited arrangements on an insolvency side, although they had fairly extensive financial support. And even as recently as last week, there was a big tourism and an airline package approved. All the restructuring agreements, repayment plans, compositions with creditors that are due to expire between February last year and the 31st December this year are automatically extended by 6 months. So if you did a 1-year IVA, it then turns into 18 months. A 3-year CVA will be 3 years, 6 months. Insolvency petitions were suspended until June last year, but they've not been, there's been no further suspension. Italy was one of the countries that suspended their capital adequacy and maintenance provisions. Germany, likewise, they suspended the company's obligations to file for insolvency, but that's now passed. That expired at the end of March, as did the directors' requirements. So things are getting back to normal now with Germany, and they introduced a new restructuring act in January that's broadened their whole restructuring legislation more along the lines of the UK moratorium. And lastly on the list, the Netherlands, as I say, again, new bankruptcy provisions came in January with the aim of making it easier to reach a compromise between creditors, shareholders and a debtor company. The Act also brought in a temporary process where a debtor can apply to court if there's a bankruptcy petition, or if there's a continuity risk of the business failing because of some enforcement process. They can apply to court for the process to be stopped and payments to be deferred. They need to show that it is COVID related, and then put forward some proposals to resolve the situation. But that's the sort of fairly limited impediment to the insolvency rules in the Netherlands. Just quickly, a few insolvency stats. There's usually a big time lag with them, but France, Spain and Germany all have some fairly up-to-date ones, all showing exactly the same situation. First quarter of last year was down on 2019. Second quarter of last year, up 50% in France, up 10% in Spain, and up 4% in Germany, but they're expecting between 6 and 10% increase this year and 15% next year. That's my quick run through of insolvency in Western Europe.
Okay, thank you very much, Adrian. All good stuff. Again, moving on. So finally, but not least, of course, Declan. I'm just going to get your slide ready. There we go. So, Declan, over to yourself. And please keep any questions coming in, because we're fast approaching Q&A time. Thank you.
Very good. Okay, and thank you very much, Martyn, and thank you to all the previous speakers. So, and welcome everybody, and appreciate your patience and for hanging on with us for so long. So it's really great. I suppose one thing that I would be kind of known for is to be being fairly positive and upbeat, and it's something that I hold dear and I like to share with people. And unfortunately, I won't be able to start the presentation today on that note. Hopefully, I'll end it on a high, if that's okay, and give you some do's and don'ts. So I'm just going to give you an overview from the first slide. And then what I want to do is give you some practical do's and don'ts as credit managers in terms of what you need to be doing and what you can do right now. Because I know we've been hearing from the experts around Europe. I'm obviously speaking to you from Ireland, and it's my view here, and you can take it or leave it. And again, I don't want people to get depressed over this. I honestly believe that we are in the worst recession the world has ever seen. In terms of productivity, in terms of national, and the difference between now and Bav, I know you mentioned 2008, and it's funny because we had a conference in 2019, and you know, to us around this table, probably 2008 is fairly recent history. We asked for a show of hands in the audience as to who was working in 2008, and less than half the audience was even in work. So the 30-somethings who are now managing companies were in school and college back 13 years ago. So it's amazing. So that's why we have such small memories. So we saw the carnage that happened during the crash, but what's happening this time is different, because governments are borrowing vast amounts of money to keep the economy propped up. They're borrowing huge amounts of money to keep people with income, with pandemic payments and grants and wages and this furlough system. And my fear is a lot of people who are currently furloughed are actually unemployed and they don't just know it yet. And the other thing about credit guys, and hopefully it's all credit guys around the table, we know it's okay to borrow. We also know there's a time when the borrowing has to stop. And then there's a time when the money has to be repaid. And that's when the fun is going to begin. So anybody who's out there right now working in credit, my message for you today, not to depress you, but to say, look, we are only entering into this now. You know, we've had all the supports and everything else. And the credit managers, you guys have to be wide awake and vigilant. And yes, you have your hands tied behind your back with ancient information and everything else that's going on. So you need to step up your game, because your responsibility is to protect your business, to protect the company, to make sure that your business survives. That's what it's all about. So, you know, that's really what you know, and when all these schemes and all these supports and the European Small Business Assistance Scheme, when they run out, we're going to see a totally different picture. Now, look, we're credit guys. We don't control the economy. We can't sort all the problems in the world out. So all you're expected to do, and my advice for you today, is all you can do is, if the tsunami comes, that you have to make sure that your company is in the best possible position it can be. So what that means is managing things really, really tightly within your company, and to make sure that you have a full handle on your exposure. So what I want to do is, I've only a couple of slides to share with you. And what I want to do is, I want to share some do's and some don'ts. So over the next 6 months, because we've seen, yes, the amount of insolvencies is falling. There's a hold on them until, you know, the end of the year. And there will be a pent-up demand. So certainly when January 2022 comes around, we can expect a sharp rise. And the fact that you're here today, please let you not be the one who's caught out by it. So we're expecting it, we're looking for it, and we're ready for it. That's what I want to talk to you about today. So that is your job. So if we go on to the next slide, just to give you, I'm only going to do five do's. So yes, it's great to see what's happening in Europe and, you know, the wonderful economic reports to see what's happening in the world. From a credit management perspective, though, we have to drill down into our sectors, into our individual customers. We have to really, you know, have this balancing act more than ever. So it's not caution at all costs. It's not batten down the hatches and withdraw credit. We still have this tightrope that we need to walk between being commercial and selling stuff and being risk aware and managing it. So that's huge that you have to look at. So look at different sectors. You know, we mentioned, you know, hospitality, we mentioned travel, we mentioned all the areas. So, you know, look at your ledger and segregate it differently now in terms of the impact of COVID and the other pressures that's coming on it, and do your own risk assessment, you know, because only you know your business. And, you know, obviously look for help and get as much information as you can. You know, it's up to you to look at your business. Your own scoring model. And look, it's not all that complicated. You can do it. And even though the information may be 2019 now at this stage, guys, you have the best information on your fingertips. The information you have is the monthly sales that each of your customers have bought from you. So you can see the ups and downs of their business in the last 12, 18 months. And you can also see the payment performance of your customers. So from those two metrics alone, without getting any accounts or whatever else, you can see the performance of your customers, and then you make your credit decisions on the basis of that. And the other thing that I would highly recommend, and I was doing this 20 years ago as a credit manager, that for my top 10 customers that represented a huge portion of the exposure, and particularly the high risk customers, I would have sometimes annual and sometimes twice a year, financial reviews with them where I would sit down and say, how is it going? What are your sales? What are your profits? Open the books, show me what's going on, and to give me an insight into their business. And once it was done, where I'm looking to help them, I have to go to the board and recommend an increase in their credit line. And look, give me something that I can go and convince these guys to give it to you. And when it's phrased like that, you will find customers are more likely to engage with you. So go and get the information yourself, not for everybody. We don't have the time or the resources. For the key customers who are high risk, who will hurt you if they go, that's something that I would highly recommend that you do. This is probably very basic, but guys, get complete and correct invoices to your customers. The amount of queries, and the bigger the customers are, the bigger the companies are, as I see it, the worse they are at credit control. So get your invoices right. Come on, and let's not accept that. And you say, oh, well, I'm not getting a support to business. Of course you're not. Why? Because I'll give you an example. Take a stupid price inquiry or something of that nature. If you buy a machine for $5,000 and the retail price is 12, and your rep goes off and does a deal for 10 grand and never tells anybody, so the invoice goes out for 12 grand. What's happened here? What's happened here is the sales guy has hit his sales target because he sold 12 grand's worth. Yeah, he's probably got his commission on the 12 grand, so he's perfectly happy. The finance people are seeing improved profits on their P&L account, so they're happy. And they're seeing increased turnover on the sheet, so they're happy. So everybody's happy except you. Because you know that the sales are overstated by 2 grand. You know the profits are overstated by 2 grand. And you also know that the customer has that money in their bank until such times as it's paid. This cannot be acceptable. And you're the ones who have to raise the flag and say, come on, guys, we're in this together. Cash is, and we all have to work together to make sure that the cash is collected on the due date. So in terms of accepting queries, stop that. And when December 31st comes, the older the debt, the longer the queries are going on, the less chance you'll have of ever resolving them. So what I'm urging you today is to bring that sense of urgency back to your office. Come on, this has to be sorted now. And the longer we leave it, the worse it is for everybody. So, your company is relying on you to make sure that happens. And incorrect invoices, I'm sorry, I have no sympathy for it. And from talking to credit controllers as I do, they spend most of their time dealing with queries, and it's just not acceptable. And I hope that you come away from today thinking this is not acceptable. If we get it right, that's it. The second thing is in terms, leave no doubt about what day the money is, not 30 days or 30 days net or 30 days from receipt of invoice. Come on, knuckle down on your terms. We'll give you money, we'll give you goods in July, and you have to pay us on the 28th of August. That's how it works, not the 29th, 28th. And once you have that clarity of systems, then that's what it's all about. And in terms of problems, issues, look, that's our day-to-day stock in trade. That's what we do. The reason we stay with credit is we love solving problems. And people who are good at credit are good at solving problems. So come on, let's get in there. Let's get them sorted, and that's what it's all about. Engage with credit associations. I know Case was talking to us about the association. Look, there's CICM, there's AICDP, there's loads of different organizations. In your career, you have to talk to other people. Credit is a people business. And now when information is at a premium, talking to your peers, now is the time we need to build those relationships that puts you at a higher level. Obviously, I am Irish Credit Management Training, so, training staff and educating them, I would say that, so you won't take it seriously. So maybe I won't say that
Declan,
at all.
Can I just say we've got 2 minutes, please?
2 minutes is fine. We'll just do the don'ts and then I will stop then. So the next slide is don't. And you might think the two of them are contradictory. Don't hold orders and don't release orders. again, people are doing this on an ongoing basis. Make sure that the credit lines you have associated with your customers are correct. Make sure that your terms are correct. And then if an order does hold, it raises a red flag. So constantly holding orders, constantly releasing orders just breaks up the whole thing. Never accept that. Accepting delayed payments, stop. No, we're not a bank, as somebody said earlier. You know, we'll supply you with goods, service. We're not here to supply you. You know, in terms of your overdues, sometimes we accept, oh, well, we always have 100 grand in our 4-month column. No, you know, you need to become almost unreasonable now at this stage and say, I am not going to accept that. And in terms of, I say, don't fix queries and disputes. What I mean there is, okay, we have to fix them, but don't just fix them. We need to solve them. We need to get to the root cause. We need to see where the communications is breaking down that caused that and solve it so it never happens again. And let's keep everything running smoothly. And once we do that, we will not be caught out at the end of the year and into next year, when it's going to have a huge impact on every business as far as I'm concerned. So look, this is my word of warning, my positive note. Get out there. You have 6 months to get your ledger into order, and use the next 6 months as a sprint to clear out those overdues, queries, disputes, make a call on them. The money's either due or it's not. Now let's sort it, and then let's move into 2022 and hopefully deal with whatever's around the corner for us. So that's all I have to say. It's been a pleasure, and I hope I've said something now that'll spark you into action over the next few months. Thanks indeed, Martyn. Thank you.
Right, okay. Thank you, Declan. Yes, okay. Well, thank you, Declan, and thank you, all of you. Hope that gives people ideas, thoughts for the coming weeks and months. That, you know, all the stuff we've heard this afternoon. I now actually want to move into the Q&A session. We have got a few questions that have come in. I'm going to go through them, so just bear with me. And I will try and pluck out some of the ones that are, well, if we can get through them all, then great. If I can't, then apologies. I've got the first question here. Oh, the first question I want to answer is, if somebody asks me if they want or if they can get a copy of the slides, the answer is yes, the slides will be distributed to the attendees. Okay, that's question number one. First question I have here is a question for Cees. How have you seen Dutch credit managers react to the pandemic? Do they see it as an opportunity to progress their career or recognition in their companies, or have they been overruled by other stakeholders, e.g. sales directors, operations, etc.?
Thanks for the question. I find it a difficult question. From the beginning of the pandemic, so March, April last year, within the Dutch ICM, we have been working with credit managers and trying to identify what are the things that are really happening and how are you in general changing the procedures and your credit managers procedures. And to be honest, the picture that I have, I may be completely wrong, but the picture that I have is that the pandemic has not really made big changes. Yes, we talk about credit managers now working from home, and we talk about maybe being a little bit more in contact or more frequently in contact with our debtors, but no big changes. Other things that I have seen that are actually going on without lots of changes is the concentration in shared service centers, the moving of activities to offshore shared service centers. So my feel, but it's not a scientifically proven statement, but my feel is that the pandemic in itself has not made big changes to the perception of credit managers and to the career development of credit managers. However, we have worked with a couple of companies And recently, 4 weeks ago, 3 weeks ago, we had an event in Rotterdam that was focusing on the credit manager of the future and what are the requirements of the credit management of the future. And the theme was the T-shaped credit manager. And essentially the conclusion, and but also the assumption was that if you want to be successful as a credit manager in the future, there are two things that are important. One is that you have to still have your deep industry knowledge. So that is, visualize it as a vertical pillar in your in the skills that you have. And then on top of that vertical pillar, you have a horizontal pillar. That is the T. And in the T, you have to have many more, you have to have skills on many more different areas, ranging from IT to negotiation skills to management skills. And the consequence of that is that the credit manager of the future will become much more an advisor to the board and an advisor to the board to help the board understand how credit management can contribute for the company to the realization of commercial goals. So I know it's a lot of words that I've said. Conclusion, the pandemic itself, I have not seen many concrete changes to the credit, but yes, there is a trend at the moment to look at the new requirements for credit managers in the future.
Thank you. Okay, I've got a question here. Declan, we are preparing for challenging times ahead with the pandemic, but right now Brexit is actually our key concern. How are Irish companies finding trade with the UK at the moment? Have you heard of any problems or issues with tariffs?
It's absolutely phenomenal, to be honest with you. I think before Brexit, the UK was one of our largest trading partner. And in the last 6 months, I think our sales to the UK have dropped by over 50%. It is absolutely phenomenal. We have also opened ports in Rosslare and Cork, where shipments now are going directly to the continent rather than through England. So the English Channel now has quietened down remarkably. And even from a customer base, our trading with the other EU partners has increased. Our trade in the UK has absolutely plummeted. And yes, there's huge issues here with regards to duty, to VAT, to everything else. Now, some of the big players, like for example, Amazon have set up a centre here in Ireland. So up to then, everything would have been coming to us from the UK, whereas now it's coming. So it's a huge issue. And certainly Irish UK trade, it's really not hitting the headlines, but the numbers are stark.
Okay, good. Thank you. I want to move on to another question for Adrian here. Please, do you think countries will introduce new measures that will still protect debtors once a suspension on insolvency has ended? i.e., will the insolvency legislation be harder to use for us credit managers than we had before the pandemic?
I don't think so. I think in the contentious sort of aggressive enforcement arena, I don't think there will be. I think there will be an increase in people trying to reach collaborative agreements, voluntary arrangements, and short-term moratorium to get over particular issues, but very short-term. So the sort of 2 weeks, 4 weeks, 8 weeks sort of process, but I don't think there'll be any significant changes to the enforcement insolvency processes.
Okay, fine. Thank you very much. I'm just looking down other questions. I'm aware that we've only got 5 minutes left. I guess this is probably one also for you. If tsunami comes, would you advise to increase reserves based on what figures, right? As the pandemic in combination with governance supports, this gives us a situation that is unknown to us all. Sort of any best guess will do. Have you got any guidance on how people should reserve for this supposed tsunami, I guess, in summary?
I think that's outside my from a credit management.
Does anyone want to take
perspective.
that question on? Does anyone? I don't know the answer either, but does anyone want to have a bash at how they think that sort of reserves, etc., may be made? If not, I'll try and find another question. No, okay, fine. We'll move on to another one. Just moving down. Okay, sorry about this, guys, because I'm just scrolling down. Okay, so another question for Declan here. When would you send out to debt collectors for non-payers? I'm not quite 100% clear of the question, but to me that means, you know, should we be getting more aggressive and sending it out to debt collection people quicker? I don't know if there's an opinion. It may not be just a question for Declan, maybe a question for Edgar.
Well, since I'm named, I'll probably jump in here first and let anybody else put their opinions in as well. I think this is something that I see as I go around different companies, that credit controllers and credit managers are far too slow to ramp up action, and they sit on debts for far too long. And I think credit managers sometimes see this as a failure or see this as a reflection on them that they can't collect it. The reality is you have resource issues, you have good paying customers, you have other things to look after. And the answer to that, it's not going to be in days or weeks or months. The answer is when you're wasting your time. So if you're making calls and the phone's not being answered, if you're sending letters and they're not being replied to, if you're sending emails that are being ignored, when you discover that you are not being effective in the collection, then you get it onto somebody else's desk in the quickest possible time. And from a management perspective, you build it into your collection funnel. It's part of the process. It is not a failure. Your job is to get the money. And if you don't have the time, the people, the resources to do it, then my advice is get somebody who will fast.
Okay, I don't know if anyone else wants to add to that. If not, I'll throw another couple of comments that are in the chat. Somebody's put here, all sales reps should be targeted on paid revenue, nothing else. Any opinions on that comment? Not really a question, it's more of a statement.
I'd be a huge fan of that, to be honest with you. And if sales reps were paid on cash collected, they would become far more cooperative and far more focused. They are greedy people by their nature. And if that's where the payoff was, they will work far better with credit control than if they get the commission at the point of sale and then the collection is somebody else's problem. So if you can bring that into your business, definitely you'll see a big change, and I would highly recommend it.
I agree with that, but I think there is also, this is also related to, a trend that, it's not a new trend. It's a trend that we've been seeing going on for almost a decade now, but that is that credit management departments have got to cooperate and have got to set up a good communication with the sales team. And so only if you work together as a team, you can be effective. And then this kind of a remuneration scheme is there to support, again, the objectives of the company. And so, yes, the conclusion is completely right, but it is not to make greedy sales managers be more decent people, but it is actually supporting the targets of the company. That is how it all should be seen as from a holistic point of view. That is how I look at it.
Okay, thank you. I'm going to just quickly dive to two more and then we're absolutely finished. We'll be really brief. Question for Tim. We can see directors are phoenixing, I don't know if there's such a word, poor performing companies trying to leave debt and restart. Do you think the credit reference bureaus or agencies are good enough at linking directorships, especially cross borders?
I think the answer categorically is absolutely not.
Right.
As with so many things, credit reference bureau, especially the biggest ones, are dependent upon process. That means they're dependent upon director pins to be recorded correctly. And in some cases, even when it's quite clear that a director has a business, for example, in Ireland and also in the UK, connecting those two in a coherent way is almost impossible. I would say that at least one agency, actually more than one, but one in particular, has the data and makes it available, but you've got to look bloody hard to find it. And it's not included in any standard reports, and it's definitely not included in any data streaming or data integration processes. It's an area of great risk, frankly. Sometimes it's deliberate, sometimes it's accidental, but I've spent too many hours trawling through insolvency or administrators' insolvency reports around misbehaving directors, and there's absolutely no connection back to the businesses that they've subsequently started up. And that's a direct fault of the inability of credit agencies to hook data together.
There's an honest answer. Thank you, Tim. I'm going to have to wrap it up there now because we are out of time. Just a couple of things to say for those people who did pose a question and it remains unanswered. Please feel free to email me directly at martyn@bakering.global, or contact me via LinkedIn if you wish. But I'm more than happy to. And I'll assure you your question will get answered. You can see by the slide I've just put up, we are actually planning another one in September around the Middle East and North Africa. So obviously look out for more details on that. You can register, I believe, at, and I'm just trying to find it, to be honest, but you can register via the website. So well, you can see it there, I think, bakering.global/resources. So yeah, if you haven't already registered, then please do so. Seems like we haven't got an exact date, but it's in September. So I think I've said enough. I'd just like to thank the panel and thank all the participants, attendees, and all the questions. I hope you've enjoyed yourself and learned something, or taken certainly bits away from this webinar. And yeah, I wish you a good evening and a good rest of the week, and take care, everyone. All I can say, and thank you.